Hi, I'm Aoife Devitt, and welcome to today's Markets Happy Hour podcast. It is Thursday, August 28th, and I'm delighted to be joined today by Apollo's chief economist, Torsten Slok, who you will see on screen there. And I've had many of these calls with Torsten. They're always highly enjoyable, a little bit provocative sometimes in terms of pushing us out of our comfort zone in terms of the way we think. And I'm also joined here in St. Louis by some of my colleagues from Ronetta as well. So we'll have a good interactive discussion, hopefully. And let me just bring up my slides. So I've called this week's podcast Fireworks and Firings because we've certainly had a continuation of the flooding of the zone and more than one firing, or at least attempted firing, of a governmental official. We've seen members leave from the CDC and also from the Fed governor. So this is coming off the back of a recent firing of head of the Bureau of Labour Statistics. So all of that is adding to the news flow, which Torsten and I will dissect. And as usual, we're going to cycle through 5 key topics: inflation, interest rates, equity markets, geopolitics, and other asset classes. And just in terms of some sub themes before I turn it over to Torsten, as I mentioned, fireworks and firings, all of this flooding of the zone. Torsten's going to take us through what inflation is looking like and do a bit of a vibe check, apologies for the slang, on the economy and talk about what it's looking at from a strength and a growth standpoint. We're then going to switch to what the bond market might be telling us in terms of some of the spreads we're seeing at the long end of the curve and whether we should be getting either confidence or lack of confidence from some of those indicators. We're going to switch to equity markets and speak about the concentration there in equity markets and some of the themes that we're seeing. And we will, if we have time, touch on geopolitics and how that is, again, continuing to rumble in the background. And where we can, we will discuss some portfolio implications of all of this macro discussion. I'd invite you to bring up your slides and we can kick off with a discussion on inflation.
Yeah, so thanks so much for having me. So the vibe check on the economy is really quite simple. That this chart here shows you to the right, the outlook for growth is going to be weaker over the next several quarters. That's the consensus expectation. That's the Fed's expectation. That's our expectation. And the reasons why growth is going to slow down is because of the 3 things that we have listed there in the box in the right-hand corner. Namely, number 1, trade war is slowing growth down. We also have immigration restrictions. If we have fewer immigrants coming in, we also have less job growth. That is also pointing towards a slowdown in growth over the coming quarters. And finally, we also have student loan payments restarting. We have had for the last 5 years a pause on paying back your student loan, and now you have to pay back your student loan again. If you don't pay back your student loan, then your credit score will begin to go down. And there's about 45 million people in the US who have a student loan. That's about 20% of the adult population. And if they are now facing headwinds because of a falling credit score, that also argues for growth slowing down over the next coming quarters. In other words, we do not view this as a recession. This is not like the chart to the left. This is not Lehman Brothers. This is not like COVID. This is what you could describe as a Nike swoosh, where growth will be weaker in the near term and then begin to look better next year. And to the inflation question, as you're asking, there are some very important developments when it comes to inflation more recently. Because the 3 things I just mentioned, namely the trade war, immigration restrictions, and student loan payments restarting, especially the trade war and immigration restrictions, are arguing for some upward pressure on inflation over the coming months. Here in the blue line, you see goods inflation. Goods inflation has been going up because tariffs are on goods. Tariffs are not on services. Tariffs is only on goods and products that we import from China, from Canada, Mexico, and from Europe. And you can see in the chart that goods inflation has been going up. And if tariffs are now going to get implemented over the next several months, you should expect the blue line to move higher. For a long time, the conversation in markets has been, well, it's only goods, and goods only make up 1/3 of consumer spending. 2/3 of consumer spending is services. Services, for example, housing, services flying on airplanes, services going to restaurants. And the argument has been for a while that, oh, goods inflation is going up. That's okay because it's only 1/3 of the index, but services inflation was going down. But now look at what's going on with services inflation more recently. Services inflation in the green line has actually started to move more sideways. And we get much more worried when we look at leading indicators for services inflation. The green line here is ISM services paid, prices paid, and prices paid, as you can see, is the price that service companies pay for the goods in their production. And you can see that prices paid has really started to go up. And I know that this correlation in this chart here is not great all the time, but if you ask me, what do you think is the outlook for inflation for services? I would say, well, it looks like inflation for services is actually about to go up and potentially go up a lot. So back to the chart here. If you ask me what are the vibes around inflation, well, the risk is that inflation may begin to move higher over the coming months and also the coming quarters. And finally, this is exactly also what the consensus is expecting. This chart here shows you consensus expectations to the US economic outlook. There's about 60 people who submit their forecast to Bloomberg. The orange numbers is the historical data. The white numbers is for the next 18 months, the expectation from the consensus about what will happen. And look first at the line up here at the top. Real GDP growth. The expectation is that GDP growth after last year was 3.124 will drop down, and this is the Nike swoosh, to 1.0, 1.2, 1.5, 1.9, 1.9, and 2. So in other words, a fairly sharp slowdown in the next 9 months, and then things gradually getting better as we get into 2026. And what is so highly, highly unusual about the current situation is that the consensus expects the economy to slow down and therefore also earnings to slow down. If you had asked me, what do you think will happen to inflation if the economy is slowing down? I would say, well, then inflation is also slowing down. But have a look at the second squared box here at the bottom. What are expectations to CPI? CPI inflation today is 2.5, and the consensus expects it to be going up 3.031, 3031. In other words, this is the dilemma for the Federal Reserve. This is why Jay Powell at Jackson Hole, he basically had a hard time saying, are you putting weight on growth slowing down, which says that the Fed should be cutting, or are you putting weight on inflation going up, which says the Fed should be hiking? So which one is it? Does the Fed like apples? Do they like oranges? And this is the challenge in markets at the moment, that the Federal Reserve, and as you're saying, including the firings that's been going on with Lisa Cook also, this brings a lot of debate around the Federal Reserve's job and where will they put their weight on growth slowing down, which means the Fed should be cutting, or on inflation being high, which means the Fed should be hiking. So the conclusion from our perspective on the white check for the economy is that there is a risk that inflation may prove more sticky. There is a risk that inflation may be higher for longer than what we're currently anticipating. And why is that the case? Because the risks to the outlook are that trade war is putting upward pressure on inflation, the dollar going lower is putting upward pressure on inflation, immigration restrictions is putting upward pressure on wage inflation for the sectors where unauthorized immigrants are working. That's in particular agriculture, it's construction, it's hotels, it's restaurants. So those three things combined is a real challenge, because that means that this is the reason why the yield curve is steepening at the moment, because the market is getting worried about that inflation may still not quite be down where the Fed feels comfortable about having it, namely at around 2%. So the vibe check, I will think to your question here, is where we are getting a bit worried that inflation may not quite be back in the bottle the way that we all would like it to be.
Fascinating analysis. And isn't there a word for that, Torsten, that we've been using in the UK quite a lot and doing a lot of hand wringing, such stagflation?
That is exactly right.
So, it seems that word has gone out of vogue a little bit with all the frenzy around AI and the excitement in equity markets. It's not a popular word. But if that is the outcome, what do we think? And I'm particularly focused also on how this cuts differently according to whether you're at the lower end of the spectrum, earning as a consumer, or the higher end of the spectrum. How do you think this will actually manifest? And when it comes to the consumers will be disproportionately affected by that inflation.
This is very, very important. So if we look at the distribution of wealth across the incomes in the US, you will of course see that there's a lot of wealth concentrated for higher income households. And higher income households have seen their assets since 2019 go up by trillions of dollars. In other words, high income households today, if you measure in trillions of dollars, and here I'm talking about the top 20% of incomes, they have literally almost $2 trillion more in savings than they had in 2019. Remember, the top 20% of incomes, they account for 40% of consumer spending. So high income households are important. That's a very different picture relative to low income households. The bottom 20% of households, they account for only about 8% of consumer spending. And their savings today are basically in billions of dollars cumulatively as a group. the same as it was in 2019. So there's been no increase in wealth, no increase in excess savings for low-income households. So it has for quite some time been a very bifurcated outlook for the US consumer, where high-end consumers have been doing well and low-end consumers have been facing headwinds, not only because they have fewer savings, but also because when interest rates go up, low-income households generally have more debt. So when interest rates went up, they were generally hit harder because their debt servicing costs were having a more meaningful impact on their household balance sheets. And the new development in the last few months is that now we all need to pay back our student loans. And those who have student loans are generally people in the middle to lower income households. And there's about 45 million people who have a student loan in the US. That's about 20% of the adult population. Of those 45 million, 24% are either 90 days or more delinquent or in default. So we're talking about 11 million households that are, as we speak, not paying their student loans. And work from the New York Fed tells you that if you have a FICO score, a credit score of 760, and you stop paying your student loans, then your FICO score will drop by 170 points. That means that even someone with a very high credit score of up to 800, they're going to see a significant hit that will pull them into subprime. And that means that if they go out and buy a new car or a house or wash or dry or iPhone on credit, then the interest rate that they have to pay is a lot higher. So the bottom line to your question is, high-income households are still doing well. Low-income households have for quite some time not been doing particularly well, unfortunately. But now you suddenly also have, especially since May, when you had to pay back your student loan, that middle-income households are also now facing headwinds because of student loan payments restarting. So the challenge for consumer spending is, and we're already seeing this in the data, that consumer spending is facing more and more headwinds, partly from high interest rates, partly from high inflation, and now also from the headwind that comes from having to pay back your student loan. So therefore we expect, and the Fed expects, and the consensus expects implicitly in the forecast, that spending on consumption will begin to slow down over the next several quarters.
And let's put a pin in that when we discuss equity markets, because I think that actually is an explanation for why many different companies are experiencing a different outlook right now. If you're a high-tech company with AI expenditure, it's one thing. But if you're reliant on selling overpriced salad bowls to the middle class, it might be another thing. They might simply not be able to afford that anymore. But one thing that has been touted as an offset to some of this pain, this pressure on the purse, is either rebate checks, whether it's a tariff rebate check or a tax rebate check, or another stimulus that may be dangled as maybe a sweetener in front of some of the consumers. Do you place any kind of expectation that that could be an offset to some of these other pressures?
I do think that if that were to happen, that would certainly be helping, because it is clear that consumers are indeed facing higher interest rates. They have been facing now also higher inflation, especially on tariff impacted goods, but also again the headwind from especially student loan payments restarting, and the fear, of course, that we all have. We're recording this on the 28th of August, as you said, that the next employment report, which comes out very soon, that might begin to show that the labor market is continuously weakening. And it's a labor market which over the last 3 months have shown a fairly steady weakening. If we begin to see the labor market weaken, and in the worst case, if we begin to see job growth be negative, then of course people start losing their jobs. And if that's the case, then you will have another headwind also to the consumer. So I would think of our conversation is that there's some structural headwinds that are generally putting pressure on consumers. And there could also be now some cyclical headwinds coming if people start losing their jobs and the unemployment rate starts to go up. So in that case, if we were to go down that road, then I absolutely agree with what you're saying. We would begin to see some government response checks coming or more support to households.
Let's move then to just continue on the interest rate questions for one moment. You spoke about long rates being pushed higher, and we've seen this gap between the 2-year and the 30-year get to stretched extremes. And similarly, this is a story being written around the world. It's not just in the US that we're seeing the long end. We're seeing in the UK 30-year gilt yields, for example, at rates that have not been seen since 1998. It's happening in Germany. It's happening in Japan. So how do you kind of really tell the story of what's going on? Is it just about the Fed will have to cut rates or keep rates higher later, or keep rates higher later, or is it something more sinister, perhaps a general lack of confidence that any of these governments can keep it together fiscally?
I think this is a very, very important point. Sitting here in New York, and you, of course, and you and I talk about this all the time, namely, there is a tendency in the US that we just basically think the whole story about everything going on is all driven by US developments. But this chart you have here is very, very important, including the headline from the Financial Times, namely that this is not just a US phenomenon. You are seeing interest rates exactly as you're saying and showing here going up in a lot of other countries. And therefore, of course, we should begin to think about, is there a common factor? What is the theme? And of course, the number one theme that has been pushing interest rates up for the better part of the last 5 years is, of course, that inflation went up. So therefore, the central banks in these countries began to raise interest rates. But the new development is that it's not only that inflation is going up, including still in the US, but it is also the fiscal situation that just continues to show more debt to GDP across essentially still all OECD countries. And in particular, even in Europe, you also now have Germany joining in, and also here starting in February saying we also would like to have bigger government spending, to spend 500 billion euros on infrastructure and unlimited on defense. So this is why for investors, spending some time on treasury auctions, spending some time on government bond auctions in Japan, UK, Germany, and US, just unfortunately, because it's not a particularly exciting thing to spend time on, but that just turns out to be more and more important because we need to understand if there's suddenly one day in some treasury auction in the US, which comes out at 1 p.m. in the afternoon, if you suddenly see one day that there's weaker demand, then markets could potentially start to move very quickly. That is not quite the case yet. There have been some instances of auctions tailing where the auction yield that comes out has been higher than where the yield was trading in the market. But the bottom line to your question here is that it absolutely, the common factor behind these four charts that you're showing here is indeed that the fiscal situation, and including, you don't show France, but including, of course, in several European countries, this is just more and more an important conversation. And investors, in my view, should be focusing exactly on the implication that that has for the steepening of the yield curve, where the risk is that long-term interest rates simply cannot go down so much because there's so much government bonds that needs to be sold. And at the same time, the central banks, including the Fed, will be cutting rates, which by definition means that the yield curve will and should continue to be steepening.
And it's interesting that you mentioned France, because I think there the immediate story seems to be the fact that the government seems to be a no confidence vote seems likely to pass. And I mentioned the firings at the beginning of this discussion around the two firings of the Bureau of Labor Statistics, now the Fed. Do any of these chip away at confidence around the institutions or the balance of powers? Do you think that that is factoring into any of this lack of confidence at the long end?
I do think that that is a very US specific story. Because if you and I take out our economics textbook and start thinking about what should interest rates be, in other words, what level should the Fed funds rate or short-term interest rates be at in the US? And there are some different frameworks to answer that question. One framework is what's called the Taylor rule, meaning a rule that basically says, tell me what inflation and unemployment is, and I will tell you what the Fed funds rate should be. Another framework is R star, which is a complicated way of saying there's a long-term level of interest rates that creates equilibrium where the labor market, product markets, capital markets, everything is working as it should in the US. Those frameworks all have a certain level of where should the Fed funds rate be today. So let's say that you and I are the Federal Reserve and we lower interest rates dramatically below that level. The consequence, of course, would be that we would get more inflation. And therefore, the fear, especially in the case of the US, if we do get that the Federal Reserve lowers interest rates for reasons that are essentially pulling us below what these frameworks would have predicted, then you will end up with a risk that if you have lower interest rates than where they should be, let's say in the extreme that the Fed acts so that short-term interest rates are zero, and in the very extreme where the Fed also acts with QE or yield curve control, where long rates are also zero. In that case, I would expect that you would see break-evens, inflation expectations go up, and the yield curve to steepen a lot more, because in that case, you run the risk that inflation is going to be a lot higher. We are nowhere near that point at this stage where we sit today, but it's very clear that if there is a majority of Trump-appointed FOMC members, of course, then the conversation in markets has been moving towards what will then happen. And there's a number of issues that could be happening, especially coming into next year, that potentially, exactly to your question, could imply that the markets at that time will begin to ask more questions about Fed independence and Fed credibility. I don't think that that's where we are today, and I think it's premature to come to that conclusion. But it could be that, exactly to your question, that some of the steepening of the yield curve could be driven by fears of people saying, we think that this is a risk, and therefore we already now need to take action.
And it's interesting. So, I mean, this is one of the more abstract technical issues, maybe not exactly a kitchen table issue for the average investor. I'd love to shift gears now into I spoke about the K-shaped recovery already, about with what's going on in the equity markets, because we've had this kind of bifurcated equity market for some time now with this extreme concentration. I have this chart showing how the level of concentration of the top 10 stocks is really different this time. It's up to close to 40%, and it seems to be just getting more and more concentrated. And then on the other hand, we did just have in the last 2 weeks, really, these wobbles around AI and its efficacy, its productivity gains, a little bit of a huge focus, obviously, on NVIDIA earnings. What do you make of this kind of makeup of the equity market right now? The cross indicators that we're seeing, or the contrary indicators that we're seeing, AI kind of off to the races, and then the consumers and those tariff affected stocks not displaying the same buoyancy.
That is exactly right. And I totally agree that this is a major, major issue for equity investors. If you and I really step back and start talking about what is the first thing that you learn in your finance textbook, and on page 1, it says you must diversify your investments. And therefore, the logic for many, many years was that, well, when I buy the S&P 500, I am diversified. But the challenge is, as this chart here you have is showing, that today 40% of the S&P 500 is the 10 biggest stocks, which essentially is the AI story. So if you and I would like to save some money for the future, we're trying to preserve capital, should we put it into the S&P 500? Well, if you decide to do that, that just comes with an extreme concentration compared to where we have seen the S&P historically. Just take the other example, namely NVIDIA on its own. So NVIDIA today makes up 8% of the S&P 500. We have not, going back 50 years, had any stock make up 8% of the S&P 500. So the concentration and the focus on NVIDIA and the AI story is just the strongest and most concentrated that it's been basically for decades. And the consequence, of course, of that for all investors is that, yes, we should all own a little bit of S&P 500, but this is a good time to say, you know what? The risks that I'm so concentrated in the AI story are so significant that maybe I should consider doing other things to not just have exposure towards the NVIDIA earnings and AI.
And of course, they're likely to be much more volatile as well, because we saw that NVIDIA can drop 3% in a day, and that's a massive amount in dollar terms. But because even given the pattern as to how that stock behaves, it seems par for the course. So it's another maybe expectations that need to change is in terms of how a stock and a equity holding will perform.
Absolutely. And you and I agree, and we talk about this also often. I mean, we will see AI and large language models make dramatic changes to our lives, but that statement does not imply that the AI stocks are correctly priced in the S&P 500 today. That statement will be valid no matter what. We will see dramatic changes. It's happening as we speak. We're seeing it in so many different ways. But that doesn't mean that these companies are correctly valued, especially when you start thinking about, well, what about other types of implementation and use cases for AI? Maybe if I want to buy the AI theme, maybe I shouldn't be buying the Magnificent Seven. Maybe I should be buying the AI theme through other channels, maybe to make sure to get exposure in other ways to how AI is going to change our lives, because these companies are now so big and they've grown so fast. So it really is equivalent to you and I would totally agree that I should have bought a stock the first day that Starbucks opened. But do I also want to buy stock in Starbucks when they have 20, 30, 40,000 stores around the world? If you have growth that's so big, the growth rate automatically begins to slow down. And as an equity investor, you are buying into the growth rate in these growth stocks. So that's why if the size of these companies now is so big, then there begins to be a limit to how much further they can grow. And that's another reason, to your point, that the volatility that can come simply because, I mean, Tesla has a PE ratio of almost 200. It's remarkable. The PE ratio for the S&P 500 over the last 50 years has been like 17. So it's dramatic how some of these valuations have gone out of whack, in my view, relative to where a lot of the other stocks in the S&P are trading.
And it hasn't been getting the same attention, but we have seen behind the scenes kind of a growing interest, or at least a growing resurgence in Asian stocks in emerging markets outside. Despite the tariff noise, we're seeing kind of a slow, I suppose, resurgence of belief in that story. And I know that you've always advocated global diversification, and we've always tried to bring a global lens to this discussion. Do you think that perhaps there is still legs in that non-US rebalancing trade?
I do think that this picture here shows you net foreign purchases of US assets. So let's be very precise. This shows you What have foreign investors done in US financial markets since the beginning of the year? The green bar is January, February, March, April, May, and June. And have a look all the way to the left. In April, after Liberation Day, foreigners were selling US assets in the orange bar. They were selling treasuries and notes. They were selling equities. They were buying, interesting enough, public corporate bonds, but they were also selling government agencies. Now look at the data for the red bar and the gray bar. What happened in May and June? Foreigners came back big time to US financial markets. So this is one way of saying the reason why the dollar is not going down is that there are, unfortunately for the Europeans, some problems, especially in Europe, also problems in Japan and problems in other countries, including for fiscal reasons. So this chart here shows that the cleanest shirt, at least from an investing perspective, has been now for quite some time the US. It was really only in April that there was this theme of sell America. And since then, the theme of buy America has been coming back. So to your point, that doesn't mean that there's not opportunities for investors abroad. There are plenty of opportunities, including also in some parts of Asia and including, of course, also in China to your chart. But the bottom line is that it is still the case that, especially when you look at the G7 countries, that the US just continues to benefit from still being the cleanest shirt and therefore still having tailwinds to inflows to US financial markets.
Well, Torsten, this has been an extremely comprehensive discussion, and I think there's probably nothing that we haven't cycled through. I put up my disclaimer there, and I'll bring yours back in a second. But just in terms of, just to finish this out, so you mentioned the US dollar. We've talked about geopolitics. Two questions, if you don't mind, and if any of my colleagues have any questions, please feel free to chime in. This will be a great time. First question is about geopolitics and its effect on markets. We've had a lot of geopolitical news. Peace overtures that were maybe expectations were not met. We just summit in Alaska. We've got continuing turmoil in the Middle East. Does any of this have the same effect, or do you think that we're having just a different type of equity market today?
So I do think that financial markets and especially the stock market has changed, especially in the last few years. This concentration issue that you and I have talked so much about continues to be very important. It's a very, very important argument for diversifying, and in particular, diversifying before any bubble potentially might burst. I totally agree and understand there may be a bubble, there may not be a bubble. There's a lot of considerations that one can put into the AI conversation, but the conclusion still is it has been a very nice run in a lot of names in the S&P 500. So why not take this opportunity to begin to think about diversification? Likewise, from a global perspective, there's plenty of opportunities globally. This is also a good idea to look at, of course, what might be going on the global front of opportunities. And finally, of course, there's also things to think about in private markets, in private credit, in private equity, but in private credit especially, the yield levels that you can get at the moment continue to be very elevated and, in my view, very attractive, simply because the central banks have raised interest rates, and still, especially in the US, interest rates staying higher for longer because inflation stays higher for longer, still argues for investing in fixed income and getting a steady cash flow. So I would put it the following way, that in my view, I would much rather sleep well at night and take some of my more risky allocations and put it in to more stable and steady cash flows. Yes, I do like the adrenaline rush that comes from Nvidia earnings and is AI going up or down, but I do think that this is the time to begin to think about maybe there are other things that I can do and I can benefit from, and really, in my personal case, sleep better at night, simply to make sure that I'm not overly exposed to a sudden change, especially in the AI sentiment.
Well, extremely well said. I'm just going to, any questions from anyone in the room? No, but we've got one of my colleagues. I got a question, so go ahead.
Sure,
Please.
just on the idea of slower growth, and when you look at consensus or even just your own expectations, and you see 1%, that at least in recent history, 1% growth doesn't actually happen that often. It's normally you're either +2 or you're -1 or whatnot. So, in your view, is a 1%, 1.5% GDP growth, is that an actual expectation, or is that just an aggregate of a binary outcome between a sharp sell-off or continued growth, strong growth?
This is a very important point. So this chart here that we talked about that shows you consensus expectation, this is exactly as you are highlighting. This is quote unquote just the average of a group of roughly 60 people who submit their forecast to Bloomberg consensus. And it shows you exactly some numbers that there might not even be one individual forecaster who has exactly this forecast here. But what I put most weight on, exactly as you are highlighting, is what I didn't mention, namely the upper right-hand corner, the probability of a recession. And the consensus is telling you today that the probability of recession is 35%. That's pretty high, in my opinion. If you look at the S&P 500, that's not what I would expect. If you look at IG spreads, high yield spreads, loan spreads, I would absolutely not expect that the market would have an expectation that there's a 35% chance that we get a recession in the next 12 months. So you are right. We should not underestimate the risk that we could potentially have a sharper slowdown if these three headwinds to the economy, namely the trade war, immigration restrictions, student loan payments restarting, if these headwinds turn out to be stronger, we will have the risk that it could be. I do not expect this for now to be a Lehman shock or COVID shock, but we could come into a scenario where we might dip below zero and where we might then have the risk of having a recession. And of course, if that's the case, then we all as investors should go back to the drawing board and start to think about asset allocation. But that's why even today you can begin to construct your portfolio with that risk in mind, that there's roughly a third likelihood of a recession. Is my portfolio constructed in a way where I am protected if that scenario does play out? Just similarly, am I protected also if other scenarios play out? For example, if I, think about these other scenarios that I've talked about, if there's a risk that, say, interest rates go down more and therefore inflation goes up more. If inflation goes up more, do I have anything that will make me money in my portfolio? If inflation is going to be higher, meaning do I have tips, break-evens, do I have steepeners? All these conversations, of course, are very important to have with your financial advisors, of course, and discuss very carefully. But I do think that when you and I, our jobs is to list the risks that we think about, which is exactly what I often had on her title page. These are the risks which exactly we all agree on are the 5 things which you'll be talking about at the moment. And do I have a portfolio that's constructed well if these risks do play out? And with that backdrop, exactly to your question, if there is a sharper slowdown, then I should have something in my portfolio that at least gives me capital preservation and protection if there is a harder landing coming.
Fantastic. We always like to have the so what for my investment portfolio as the kind of the conclusion to this wonderful discussion that we've been having. Any other questions? Josh?
Sure. Torsten, you kind of shed some light on this earlier in the one slide. But just curious your thoughts around the portfolios and what their exposure should be toward U.S. domestic versus international stocks. Do you think there's a shift right now happening, going forward? Historically, we know in the 70s and 80s, international outperformed U.S. The 90s, U.S. outperformed international. And reverse happened in the early 2000s. And, in the early 2000s, we were roughly at like a 60-40 ratio, 60% US, 40% international. Do you think there's a shift now of going more towards 70-30 exposure? Just curious your thoughts on that.
Yeah, so I do think that when constructing portfolios, we should always look very carefully at what opportunities are there abroad. The key issue in that discussion at the moment is the outlook for the dollar. And the discussion around that during April, when Liberation Day happened, we did see the rest of the world sell US assets. That's what we saw in the tick data for treasuries. That's also what we saw for equities. But when we looked at the data for May and June, and we will also soon in the next few weeks get the data for July, then we saw very clearly that the rest of the world did have an appetite to come back to US financial markets. And given how the dollar has behaved, I know it behaved, of course, with a very strong depreciation of 10% since the beginning of the year, but it has moved sideways here more recent in the last 2 months or so. So unfortunately, with some of the challenges, especially in Europe on the fiscal front and politics, that is making me a little bit more worried about that maybe the dollar decline is no longer as obvious as it was in the beginning of the year. So that's why I do think that views on what should I do with the international part of my portfolio, they should certainly be informed by, do I have a view on whether I think the dollar will go up and down? What I also think is important in this conversation is that I also do think that we should all, and this is the modern world in my view of thinking about asset allocation, we should also all continue to think about private markets, especially private credit, but also private equity opportunities, especially with money that we don't need here and now, but that we can put away for a few years. There's a little bit, in some cases, issues that maybe you have a little bit less liquidity, but the investment opportunities and some of the return profiles over the last several years, they do argue that maybe as an alternative to thinking about international is, of course, to begin to think about maybe there are some opportunities for excess returns investing in private markets in the US, of course, including in particular in private credit.
Well, I think we'll end it there, Torsten. This has been an absolute delight. I don't think there's an issue we haven't touched on. As always, you bring a wonderfully fresh perspective. So thank you so much for your time. And thank you, everyone, for listening to the Markets Happy Hour podcast.